Hello.
Hey, it's Michial at Ready Ray giving you a call again. How are you?
Great. Thanks, Michial. Yeah, I'm doing great.
Okay, good. And thanks for letting me call you back. I appreciate that. So I understand you're looking to purchase a second home, right?
Yep. I currently rent up here in Massachusetts. I used to live in Florida, and I'm now considering buying a condo down there. So she recommended that I go with a mortgage lender from Florida because the laws and the rules and all that stuff are a little bit, specific to the state. So she recommended I give you a call.
Yeah, especially with condos, if you're looking at condos in Florida, but across the
Correct.
board, townhome, single family, there's definitely some advantage of having local expertise. That's for sure.
Okay. Good. Good.
So let me just ask you some questions. I'll kind of unpack your situation. So so you said you don't own any real estate currently, right?
I do not. No.
Have you owned any real estate in the last 3 years?
No.
And you said you live in New Hampshire currently, right?
Massachusetts.
Sorry, perfect. And so the new purchase is definitely just going to be a vacation place in Florida, a true second home, right?
It'll either be a vacation place or it may be a rental property. I'm not quite sure. So.
Okay. You're still trying to work that out?
Right.
So tell me, are you leaning towards single family, townhome, condo? Are you open to occupancy? What would you say?
I would say condo is probably what I can afford right now. So.
Okay, very good. So let me ask you, are you married or single?
Single.
And are you trying to buy the new property in Florida with anybody, or are you going solo?
Solo.
Perfect. What's your credit score approximately?
820.
Great. And tell me about your savings. How much savings do you have available that you're comfortably ready to use towards your purchase?
I think I could put 20% down, so I have up to say maybe 50,000 that I could put down.
Okay, good. And obviously you'll have closing costs and stuff on top of that.
Mm-hmm.
Would you say that 50,000 is your all-in number, or would that be just the down payment plus closing costs on top of that?
I actually have like 100,000 sitting in an account that I've like reserved for when I sold my previous condo that I had. I've had it sitting in there for a few years, so it's now matured to about like $100,000. So I don't want to use all of it. I'd like to keep some as reserve for sure.
Okay. So is it fair to say that you have a maximum purchase price goal on the new condo of $250,000? Is that fair to say?
I think that would be reasonable. Yeah.
Okay. And all condos are going to have association fees. What's the most you would pay for association before you're like, out of principle, I'm not paying that?
I guess it depends on the price of the condo. If the price of the condo is low enough, I could go up to like $600 or $700 in HOA fees. If the price of the condo is higher, then the HOA fees would have to be lower. Does that make sense?
If we assume that you buy at your maximum purchase price goal of $250,000, then is it fair to say $700 would be your max HOA goal?
Sure, we'll say that. I'm not sure I can afford that, but we'll say that. Yeah.
Okay, we'll say that for now. Don't worry. At the end of this conversation, we're going to crunch numbers and I'll help you get an idea of affordability. You said my favorite word, affordability.
Okay,
Remember,
good.
I work to qualify you for the mortgage, but that has zero to do with your ability to afford the mortgage. And that's all about your household budget and all that very important stuff. So we'll talk more about that in a sec. But
okay,
you're giving me some initial puzzles on the table to put together.
Sure.
Yep. So let's shift gears and talk about your debts. Do you have any car payments or car leases?
I do not.
How much is your monthly rent?
It's about $2,500.
Okay, good. And how much total credit card debt do you carry?
None.
Great. Any personal loans or student loans?
No.
Good. And some standard questions. These are probably all no's, but I'll ask anyway. Any obligations to alimony or child support?
No.
Any outstanding IRS debts?
No.
Any bankruptcies, foreclosures, anything like that in the past?
No.
So no debts. I love it. And let's shift gears now and talk about income and employment. Are you self-employed or do you work for a company?
I work for a company.
Great. How long have you been with your current employer?
Going on 13 years. Oh, wait, hang on a minute. 2012. Yeah, 13 years. 13 years.
W-2 position, is that fair to say?
Yes.
Good. And are you hourly, salary, something different?
Hourly.
Hourly. Okay, good. And what is your current hourly rate?
$72 an hour.
Okay, good. And how many hours a week do you let them work you?
It depends. Sometimes 36, sometimes 40 or more. I'm a nurse, so with on call. So I sometimes work more, but my base is 36 hours a week.
Okay, good. 72 an hour, 36 a week. Perfect.
That's base. Yeah, I make more than that, but that's my base. Yep.
I love it. And when you say more, it's probably through like shift differentials and maybe some
Exactly.
overtime.
On call and overtime. Absolutely. Yep.
Cool. So what was your total earnings last year in 2024?
I'm just going to get ready to do my taxes, but I think somewhere around 165,000, somewhere around there.
Good. And I know it's hard to give me the best answer you can for 2023. What was your total earnings approximately?
Let's go back. I think it was closer to like 150.
Okay, good deal. Well, I mean, listen, you're what we call the dream client.
Okay.
Yeah, you have amazing credit. You've got incredible savings. You sounds like the money's been in the bank for a while now. It's easy to source, and you know, obviously you have a goal of using up to 50 grand, but you can do a little bit more if you need to. You don't have any debts. You got an incredible employment history. You make a great living. Your earnings over the last 2 years have been solid, more than enough income to qualify for whatever you're trying to do. So all those are positive. So I think the most important thing to talk about next would be that affordability factor. Like I mentioned, totally different than your ability to qualify. You have no worries qualifying, so just be proud of that. Yep. You earned it. So now let's talk about affordability. So I'm going to just go with all the maximum things we talked about. So 250 purchase price, 20% down. I'm just going to make an educated guess on a condo at a purchase price of 250. I can't imagine homeowners insurance is going to be more than maybe $75 a month. It's only a guesstimate, but remember with condos, you're only insuring the walls in. The master insurance policy of the condo will cover the walls out. Yep. And so you have more insurance expense, but you're paying it through your HOA dues. So taxes, again, just an educated guess. Shouldn't be too dramatic. You won't be able to homestead the property since it's a second home, so they'll get the maximum taxes out of you. But again, it can't be more probably than like maybe $3,500 a year. We'll go with that for now. And we'll say $700 for the HOA. Fingers crossed it's less, but we'll go with that for now. So obviously no debts, and your 2-year average on earnings is about 155. It sounds like, so we'll go with that for your qualified income. And yeah, so again, easy to qualify, but from an affordability standpoint, I want you to use the number $2,450. So that total monthly payment, based on everything that we just talked about, would be about $2,450. You just want to round up to 2,500 just to make the math easy. You know, again, remember I'm making some estimates, so give yourself that little bit of a buffer when you're messing with your budget, I always say. Right. So if you're at 2,500, and then your total out of pocket, again, I'm probably overestimating a few things I typically do in the beginning, but including everything, your down payment, your closing costs, everything, going to be about $63,000 is my guesstimate. Yep. So 63, you know, well within your 100,000, a little more than 50, but still well under 100. So I think the real question for you is, you know, how does 2,500 fit into your budget? Right. That'd be an additional $2,500 on top of what I'm paying here right now for rent up here in Massachusetts. You said your rent there is $2,500 also, right? Correct. Yeah, cool. And then as far as like, you know, it is important, if you know for sure that you're going to rent the property, we need to buy it as an investment property. If you're on the fence or you're pretty confident it's going to be a second home initially, there are some differences. There's some slight differences in interest rates. You know, you're already putting 20% down, so you know the minimum down payment on second homes is 10%, and investments are 15% minimum. But you know the differences are pretty subtle. But we always want to be honest with occupancy. You know, occupancy fraud is a real thing, and we don't want to budget. So if you're confident, you don't have to answer this question right now, but when you're ready, let me know. You know, Michial, I'm definitely confident that I'm going to rent it. So then let's treat it as an investment. Or if you're like, Michial, I really don't know if I'm going to rent it. It's going to be a second home first, so I can come enjoy Christmas on the beach. And it's going to be a second home. And we can figure that out later with a final answer. Okay. I think I'd have to be honest with you, I think I'd have to lean towards renting it first, just so I can feel confident that I can swing it. You know, the payments and everything. And depending on where I buy, I understand some places
you can't rent it after the first year or two. So, you know, like,
yeah, if you do buy in a place where you can't rent it for a year or two, then we're going to go ahead and treat it as a second home, because that's far enough into the future that it's uncertain, you know.
Okay.
As long as you're going to, you know, have it as a second home for at least a year, definitely, which it would be definite in that situation, we'll call it a second home for sure.
Okay, perfect.
If that stipulation doesn't exist, then maybe we go back to investment.
Okay.
Cool. All right. Well, so I didn't hear you answer my question, and you don't have to right now if you don't want, but how does that $2,500 stack up to your budget?
It makes me a little nervous that high, to be honest, because now I'm shelling out $5,000 a month for housing. So I think I'd feel more comfortable with, you know, closer to all in for all my expenses and everything, closer to closer to 2,000. But that's kind of where I am at right now. But it's good to know that I could still swing it. It would just make my life a little bit tighter until I could rent it, if that makes sense.
Yep, totally makes sense. Well, let me give you some food for thought. So right now, interest rates on second home and investment purchases are in the upper sevens, generally speaking.
Okay.
Right now, I'm using an estimate of about 7.875.
Okay.
So again, that could totally be different by the time you're under contract. It could be better, it could be worse. We just don't know right now. Yep. But the other thing I wanted to tell you is, for every 25 grand that you go up or down on your purchase price, assuming that everything else stays equal for this argument, so we're just talking about principal and interest really at the end of the day. So every 25 grand you go up or down, it's going to change your monthly payment by about $150.
Okay.
So if you go to 200 for a purchase price, and let's say it still has a $700 HOA and the other estimates for insurance and tax hold true, now you're looking at a payment 300 less. So instead of 2,500, you'd be about 2,200.
It's not that much, really, when you think about it. Yeah.
No, got to remember, it's amortized over 30 years. So that $25,000 flux in your purchase price doesn't have that significant of an impact, unfortunately.
Right.
But with that being said, I'm a huge proponent of trying to live below your means and operating, your budget. I call it your truth serum. It tells you what to do, so be as truthful as you can. It doesn't mean you can't go back and have a conversation with your budget and maybe tweak things a little bit, but just remember, at the end of the day, what your budget says, if you follow it, it's very rare you're going to find yourself in a pinch.
Right.
But anyway,
and so that's a 30-year mortgage that we're talking about too, right?
It is. Yes, ma'am. Yeah, we definitely have options to do smaller terms, but if you're kind of payment sensitive and you want to manage your cash flow, don't do it. There's no good reason to do a shorter term unless your income is 100% bulletproof and you have no cares when it comes to monthly expenses or anything. What I can do for you, if you're doing really good today and you got extra money, then I'll just tell you exactly how much extra to pay on a 30-year mortgage every month to turn it into a 15-year mortgage.
Okay.
Yeah, but the great thing about that strategy is you remain in control of your cash flow. So God forbid life happens and you need to allocate those funds somewhere else, you can do it because you're in control.
Right.
If you start off with a 15-year mortgage, you don't have that control.
I like that. Yeah, I like that because I would. When I had my other condo, I always paid a little bit more every month on it, because I could. And there were some months that I couldn't, but most months I could. So I do like that strategy a little bit better. Yeah,
from experience, fortunately, I had an experience once in life where I got talked, before I was ever in the mortgage industry, I got talked into refinancing my 30-year mortgage into a 15-year mortgage. And it was just, at the end of the day, the person was just trying to earn a paycheck and it wasn't good advice. And then sure enough, something happened in my life that made that payment difficult, and I ended up having to go through a painful modification to go back to a 30-year term after I spent $5,000 on a refinance. And if that person would have educated me correctly, they'd have said, don't do this. The interest rate isn't that much better, and I'll just tell you how much to pay. Your effective interest rate will be less, and you'll still hit your goal of paying it off in 15 years. So anyway, it is good advice.
Good. And then we could always refinance once interest rates drop, if they ever drop, So
from your lips to God's ears, let's keep saying that.
Right. Right.
But listen,
seriously,
if there's any indication, rates are going to come down. I say this to all my clients. If you're thinking about buying a house right now, don't worry about I know this sounds crazy, but don't worry about the price of the home and don't worry about rates. The things you should worry about are, number one, is this the house that checks all your boxes? Is this your dream house, or does it at least check all the boxes? That's number one. And then the more important question I've already gone over with you, can I afford the monthly payment as it is today?
Yeah.
And if the answer is yes and yes to those, like there is very few instances historically over the last 30, 40, 50 years where owning a piece of real estate was not an incredibly smart financial decision.
Right. Okay.
Yeah.
That makes sense.
Let me give you one more scenario. So if you found a $200,000 condo, so $50,000 less, and you maxed out at a $500 HOA, guess what? Your total payment would be about $2,000.
Okay.
So what I would suggest for you is that you start your condo search around 175 with a max HOA of 500.
Okay.
And at least get out there and see what's available.
Yeah.
We know we can go higher for you, but you're going to have a heart-to-heart with your budget before you do that.
Right.
But you definitely, before you ever, because budgets don't like to talk about that kind of stuff, so I always say before you do that, see what's available in the marketplace. Let's put your realtor to task. You got a great one. If there's something in that price point out there, she'll find it.
Yeah, exactly. And I'll be looking probably more at 55 and older communities because I just turned 55 this year. So I don't know if that mingles, how that interacts with anything. But I figure getting in early at a 55 and older, if I'm going to make it an investment property and then buy my dream house in 10 years when I'm ready to retire, then at least I've accrued some interest, some equity in the place. So
I didn't say wow because of any other reason than you don't sound like you're that old on the phone.
Thank you. I don't feel like it until I get to put my glasses on, to be honest with you. So
oh my gosh.
Good. So when I start looking, like right now I have all my credit bureaus frozen because I had someone this past fall hack and get all my stuff. So everything's frozen. So I would just need to unfreeze those so, we could actually run whatever you got to run against the credit reports to get the official, whatever,
so
when I'm ready to start looking.
Just a little background. I own my own mortgage company. I've owned it for the last 4 years. I've been in the industry for over 10 years. And I do things differently on a lot of different fronts, all for the betterment of you as the consumer and for our realtor partners. We help make them heroes as often as we can. So here's one example. We don't need to check your credit. I'm very happy to issue a pre-approval without dinging your credit and creating a tsunami of solicitation phone calls. You're going to get like 202 days after your credit officially gets checked, and there's no need for all that pain right now. So the reason why is because you have amazing credit. I believe you when you tell me, and you don't have any debts, and you make plenty of income. So there's no reason there's no risk there as it relates to your credit. If your score came in at a 740, you'd still be getting the maximum benefit. And like you said, you're well over 800. So in these situations, we don't check credit up front. We won't check your credit until you're under contract and moving into, along in the process. We'll do a soft pull as soon as you go under contract so that we can at least know what the score is and because that's important so we can price your loan correctly for interest rates. And then typically a week or so into the process, once you come out of underwriting and everything's looking great, then we'll do the hard pull, and I'll apologize again for all the phone calls after that.
That's okay. Good. So where I stand right now, so say I was, I had my friend Jill starting to look for places and we saw something in the next, month or so, like, oh, you should really pull the trigger on this. Just reach out to you and can I already say like, I'm good to go, with the,
Let me tell you what comes next. That's a great question. So I'm going to take just a few more bits of information from you, and then my team is going to send out a pre-approval letter, the email. The email is going to have your initial pre-approval letter at the 175. I'll put a little note in there that says you can go higher if you want, and I'll let you talk to Jill about that. And and then in the email, there'll also be an initial loan summary, which kind of breaks down the expected expenses of buying a property. This will give you a chance to kind of geek out in the mortgage space and see what you should expect as far as where's all my closing cost dollars going. And of course, let me know what questions you have when you go over that. We'll go over that in detail multiple times later on in the process. But if you have any questions initially, just let me know. And then and then from there, I'm on standby. My team and I are here for you as you're looking at properties. If you want to crunch numbers on a specific property, just let me know.
Okay.
If you decide you are going to go up on your budget a little bit, and you want to talk about it, let me know. And then as soon as you're under contract, get me a copy of it. We'll put everything in motion and guide you every step of the way from there. One other thing I'll mention is that, one thing that we do differently too is we're going to lock you into an interest rate as soon as you're under contract right away. We're going to go out there and look for a good deal and lock you into that. And we do that immediately to protect you in case the market gets worse. Once we have you locked in, that's it. And if the market gets worse, we don't have to stress about it. Now, if the market improves while you're under contract, up to 10 days before you close, we will chase that market for you and help you get a better rate. If that means we have to move you to a different investor, we'll do that. It creates more work for us on the back end, but we don't care. We're super efficient and designed to take advantage of fluctuations in the market for our consumers intentionally. So, so that's one of the cool things. We basically never stop shopping your rate. The reason I say 10 days before closing we do is because if I do move you to a new investor to chase rate or to chase a better market, we have to redisclose your official mortgage application. And by law, we can't close for 8 business days after that. So the reason we say 10 days is kind of our point of return is for that reason.
That makes sense. That makes sense.
Yeah, it's a cool thing. We try to be very flexible when it comes to that. Other companies, not so much. They're going to tell you that they want to float your rate because they're scared to lock it because they think once they lock it, they're locked in. They're gonna try to charge you a rate renegotiation fee if the market does improve. Just an excuse to charge a junk fee. So we don't do any of that. We want you to feel confident that once you're locked in, that's great, but that's for your protection. It's not to prevent you from being able to chase a better market.
Right. Good. Now, can I ask you another question?
Sure.
I said 20% down. Like, I don't want to pay PMI and anything, but I heard you say something like like the minimum was 10 or 15% for certain things, or would you still recommend 20% down? Is that to cover so I don't have to pay PMI?
Yep. So you're definitely not going to pay PMI as long as you're putting at least 20% down. So keep that in mind first.
Yep.
And then, so when you're buying a condo as an investment or a second home, if you choose to do the minimum down of 15% or 10%, you are going to get hammered pretty good on interest rate.
Okay.
So I don't really recommend it unless it's a necessity for you.
Okay, perfect. You answered my question then. Good.
And to even take that one step further, keep in mind that if we can increase your down payment to 25%, there will be some advantages with your rate there as well. Okay. So like, for example, if you do end up finding that perfect place at 175, I might recommend that you do 25% down because your total out of pocket would still be around $56,000. Right. And that would help maybe get you a little bit of a better rate. Okay. If so anyway, we'll play with those numbers a little bit now that we understand your general goals. I'll help you tweak those as the picture becomes more clear on the property you're going to buy. Okay. That makes sense. All right. Well, that's really all I need. Do you have any additional questions?
No, that was great. Super helpful. And I'm going to go give Jill a call now and have her start looking for me. So, all right. Sounds great.
We'll send that pre-approval out either later today or first thing, probably today because it's early in the day. And you just let me know what you need, okay?
Thanks. Really appreciate it, Michial. Good talking to you.
Good talking to you. You too, Charlene.
Take care.
Okay,
bye-bye.